Welcome to Automotive Life. This channel is all about lifestyle, passion, and business. And today we're going to be going over our second part in the how to get your dealer's license and how to start a used car dealership series. And this one is going to be going on about banks and financing options. If you have not watched our first video, I suggest you go back and watch that. The icon either below me or ahead of me is going to be there. You can click on that. Make sure you watch that video entirely and then come here and watch this one so it makes a little bit more sense. And if you have any questions or comments, make sure to put them in the comment section below and we will answer every single one of them. And let's get into the video. The first step in this video is how to get banks. Now, this is one of the most crucial things you're going to do for your dealership to help you set up your long-term success. So when you're a new dealer, your job is to go out and find a lot of these different types of banks to sign you up. Now, if you're new to the industry and you don't know any of the banks in your area, one of the best things to do is go to your automotive or dealer union. They will have a list of banks that do business in your area. If not, I really recommend getting a mentor or visiting with other dealers. Some dealers are friendly and will give you information, but I'll be honest with you, about 90% of them will not. They want you to die and not succeed. Not sure why. There's more than enough money to go around, but that's the way most of these dealers are. That's why I haven't seen a lot of dealer videos out on YouTube, and the ones that I have seen are a joke. Like I said, half these people don't even have probably a dealership or a dealer's license. So get those lists of banks, start getting set up with them, set up the meetings with each of these bankers, clean your dealership up, organize everything. You want to put your best foot forward when you're meeting with these bankers, because the more they trust you, the more they see that you're going to be in it for the long term, they're going to sign you up. And this is the other thing that a lot of people won't tell you, and there's not a single video on YouTube that talks about this, is the credit part. Depending on your personal credit, and if you're a homeowner and several other things, some banks will not even do business with you. So it's very important that you have decent to great credit before you start this process, because there's a thing called it's called a title float. So let's say you sell 3 cars to a bank, to the same bank. Well, when you have a 4, 5, 6 title float, you can sell all 3 of those cars. They'll fund you, and then they just wait for the titles to come in. Now, if you have bad credit, they're going to put you on a single title float, or they'll do something even worse, paid upon transmittal. So you have to basically sell that car before they even give you the money for it. Let's say you have a flooring line, you have to pay that car off and then take the money, pay that car off, send the title into the DMV, and when they get proof that they received it, then the bank will release the funds. So it's very important that you get your credit fixed before you start this process, because it will set you up for, like I said, a lot of long-term success. And let's go ahead and get into the 3 different types of banks. Okay, we're going to give you a breakdown of different types of banks, the programs, and everything else. And then we're going to give you some real-world examples, so this way you can see how the financial institutions do real deals and all the other things that go along with it. So right now, we're going to go into, there are 3 different types of banks. You have your prime, subprime, and deep subprime. Each of these banks are made for specific customers. So your prime, you got people with 800 to, let's say, 650 credit scores. Your subprime, which is going to be probably 650 to 500. All right, and then your deep subprime is going to be basically 499 and below. Now, one of the things that's crucial for your long-term success is making sure that you have 3 to 5 of each of these lenders. And the reason why is let's say you have Mr. John Smith comes in. He has a 720 credit score, and you get an approval from one of your banks. Now, once you get an approval, you want to be able to match it or compare it with multiple offers. This is how you work your finance desk to maximize every single deal. So if let's say you have one lender that gives you higher interest but gives you a low buy fee, which we'll go over here in a minute, or they give you, and another bank gives you low interest but gives you a high buy fee, you can actually pin those banks against each other, send them your approvals, and then work to see who will give you the better deal. So make sure you have 3 to 5 banks in each of these categories to make sure that you're successful and you're getting the most money out of each deal. Okay, now this is one of the things I talk that's very important in the very first video we did is bank programs and lending wheel. Now, as a dealership owner and you're going to be your finance manager, this is very, very, very important. You need to learn every single bank program because one, you need to make sure that you buy the cars that the banks want to see. Like I said, it's not about what you want, it's what the banks are going to buy. So you want to make sure that you stay in that lending wheel like we talked about in the first video. Make sure you buy the right cars, the right miles, the right type of year, so this way you get the most profits you can out of there. And the other reason why is I've seen so many absentee owners that have no idea how to do any type of financing paperwork. So as a dealership owner, I highly recommend, even if you have deep pockets and you have a lot of money and you can afford a finance manager, don't do it. Take about several months and desk your own deals. Learn the banks, learn the programs, meet the bankers. You want to build a solid rapport with these bankers because if you get a finance manager, and if there's any dealers watching that know about this, a lot of your worries and your headaches will come from your finance managers. They will sign you up with deals. They'll sign you up with bad recourse, which we'll show you here in a little bit. They'll steal money from you. So as an owner, you need to make sure that you know everything about each program. Every time a customer comes in, starts talking about, their job time, their credit, how much money they have down, your brain needs to be calculating which program from which bank to put them into and which vehicle on your lot will work best for them. So like I said, learn the bank programs. It's very, very important. And then, like I said, buy within your lending wheel. Okay, bank fees. Now, another thing, a lot of people don't know about it, and I know there's no videos on YouTube for this, is the banks, when you sell them a deal, they charge you money. And your bank fee can be anywhere from 0%, like let's say if you have a good customer, all the way up to 35% when you have a deep subprime. So I've taken some huge hits over the years. We just had a customer last week buying an $8,000 car, and this customer is putting $3,300 down. This guy, he had a repo and, he was late on some credit cards, but not a bad guy. But the bank wanted to charge me $2,200 to take that deal. It's a joke. So what we did is we in-housed it for about, we're gonna in-house it for probably about 90 days and then resell it out to one of these banks. So like I said, the more programs you know, the better your financings are, or some of your finance options are, and you won't have to worry about getting murdered with all these fees. Second thing is risks. Now, each bank, depending on which one, has two things they usually use, two things they use for determining risk. Now, in some places, depending on which state you live in, they have three, but we'll go over the first one, which is the customer. Now, depending on the customer, they're gonna wanna know about how long has he been on the job, how long has he been in the residency, if he has bad credit, what type of bad credit is there? Did he have bad credit his whole life? Does he have one repo? Does he have multiple repos? Does maybe he have foreclosure? A lot of bad things happen to him, but now you can kind of see the steady progression. These are some of the things you need to learn about your customers before you submit the deals to the banks, because as a dealership owner and as a finance manager, it's your job to tell the story to the bank, because all they're going to do is they're going to see just basically numbers on the page. And I'll give you a perfect example. We had a customer that came in. He always paid his bills on time, but he was a union construction worker here in Las Vegas. Now, we went through a downturn a few years ago where the economy was really slow and building stopped. But this gentleman took it upon himself to make sure that he was trying to do as much as he can to pay his bills, but with no work, he couldn't pay them all. So he fell a little bit behind. So he got his car repoed. He was late on his house for a few months, but now construction's picking up. He's getting a lot of work. All of his bills are on time, but he's got that repo on there. So we're able to tell the bank, hey, this guy's been a union worker. He pays his bills. He just fell on a little bit of a hard time, but look, construction's picking back up. This guy's current with all of his other bills. Let's give him a second chance. Let's give him a shot. And when you tell the bankers a little bit of the story of what you're working with, this will help you. But keep that in mind that, like I said, one of the main things they're going to look at is the customer. Second one is the car. Now, depending on which one you go with, as far as subprime and deep prime, this car is going to be a huge factor in your bank's decision to approve you. So when you have Prime, the banks really don't care if it's a brand new Toyota or a high mileage Mercedes. They know that the customers have the money and the credit to take care of the vehicle, where some of these other people don't. So with subprime and deep subprime, if you pick, let's say, a high mileage Mercedes or a older Toyota Corolla, even though it's a Toyota Corolla, it's older, they're gonna whack you with either a bigger fee or they're gonna hit you with, it's called Recourse, which we'll go over here in a minute. They can hit you with a 1, 2, or 3 payment recourse. So make sure as you start doing deals, you learn where your customers land on this chart. So this way you can set them up in the right car so you can maximize your check from the bank. And the other one is state. Now, depending on which state you live in, this will matter. And one of the bad things about where I live at here in Las Vegas is we have a very, very high default rate. A lot of people here are very, very transient. So here in Vegas, we have a very extremely high buy fee, where compared to, a perfect example, I have a friend of mine that's in Dallas, Texas right now. So I've done this. I've sent him a customer, the same customer with 2 different addresses. We tried it, one here in Vegas and one in California. Our average buy fee here in Vegas is $1,700. Every time I send a deal out, that is our average fee of what we're paying to the banks. It's disgusting. That's how much money they're making off of us. But my friend in Texas, sorry, my handwriting is horrible. His average fee is only $500. So not only is he living in a place where his dealership is a quarter of the rent of the cost of mine is, he's getting cars for cheaper than me. His buy fees are extremely low. So he's making double the money with half the risk than I am here in Vegas. Now, most of you guys are probably watching this wondering, why am I still here in Vegas when I'm not selling cars there in Dallas? I love Vegas, but if anybody's watching this and is in Texas, preferably Houston, if there's anybody there, if you got a bunch of money and you're rich, you want to start a dealership, give me a call. My email's down below. But anyways, so the state will depend on what type of fee you also get that goes along with your risk fees. Okay. Now the next thing we're going to go over is recourse. Now I'm going to take a second and pause. Recourse can kill your business in 1 month. Now it's very, very important that you take the time. You listen to this. I recommend you listen to this 2-3 times so you got it down in your brain. Recourse is bad. The less you do, the better you'll be, or excuse me, the more successful you'll be. And recourse is basically you're on the hook between 1, 3, 4, 5, whatever the bank wants to assign you for as far as recourse payments or monthly payments. Okay, I'm going to stop and pause. We're going to talk about something that's extremely important, and this is recourse. Okay, I'm going to tell you this right now, and listen, it's very, very important. Don't set yourself up for failure. When you do a deal and a bank is asking you for 1 payment recourse, that is usually the normal. Some states, you guys have 0 recourse. There's a lot of lenders in all these spectrums that are 0 recourse. Try to do as much as you can with 0 recourse. Now, with the 0 recourse, the deal may be a couple $100 less than the ones with 1, 2, and 3 payment recourses. Take that and run. Do not sign up with recourse because, perfect example, if you have, let's say, actually this is a good one. If you have a friend that you trust and you know, and the bank is, willing to finance them, but they want to give you a 3 payment recourse, you can do it, but just keep in mind, you're on the hook for 3 months. So if this customer doesn't pay, he defaults in either the first, second, or third month, and let's say they gave you a check for $10,000, you have to give them that money back, whether you get the car back or not. When you sign recourse, you're signing a blank check to the bank. So this is always looming over your head until your recourse is over. So do not sign multiple months of recourse. 1 month is normal, that's okay, but a lot of these banks, they're gonna try to trick you. And depending on which state you're in, they will put it on what's called your approval letter. It'll be like, it'll look like this, and in the very, very bottom where you can barely see, it'll say 2 or 3 payment recourse. And you're like, you have to squint to read it to actually see what they're talking about. So you want to make sure that you don't sign up for any recourse, because perfect example, when I first started, I had a few deals from a bank that was very aggressive, wanted to take over the Vegas market. They were just buying everything. But the downfall was they were giving us 2 and 3 payment recourses. Well, 1 month I had 4 deals come back, and each of those deals were an average of probably $12,000. So, you know, they come up, they show up to your dealership, they knock on your door. Hey, you have 4 defaults. We need a check for $56,000. There's no waiting. There's no, well, I'll get it to you next week. They want a check right then and there, and you're on the hook for it. And if you don't pay it, they will shut off your lending, and they will tell all the other banks that you do not pay your bills, and they will all start cutting you off one by one. So make sure when you start getting into the lending world, do not play with recourse. Take 1 payment. If you know the person, you could take 2, maybe 3, but we all get desperate. The flooring lines are going to ask you for money. You're going to have bills to pay. Please do not set yourself up for failure. Do not take more than 1 payment recourse. Just stick with 1. You'll be fine. Don't sign anything up for more, and make sure whenever you get an approval, you take the time and you read the bottom of the sheet and you make sure that there's no other recourses, because when they show up to your door and you have to write a $5,000, excuse me, a $50,000 check, your eyeballs are just gonna get as big as mine was, and I freaked out. And like I said, you don't even get the cars back sometimes. That check that I told you about, out of those 4 cars, I only got 2 of them back. The other 2 are, there's somebody's driving them around for free somewhere. So once again, recourse, stay away, no matter what they offer you. Okay, on this part of the video, we're gonna go over the 3 different types of deals, and we're gonna write them out for you. You have your prime, your subprime, and your deep subprime. We're gonna go over how to work the customers, what cars to pick, the steps in that, how to structure a deal, and then the watch out between the approval and the fees. And sorry about my handwriting again, it really sucks, I know that. So, okay, first we're gonna get into Mr. John Smith. Now this is a good customer with, let's say, 720 credit score, all right? He's got a 1-year job, which is important. He's got his $3,000 a month. His rent's about $500 a month, or mortgage. He's got, as far as credit-wise, 2 paid autos. He's got some credit cards and his mortgage. So this is a typical prime customer. So knowing this in the back of your head, you need to start lining up the banks that you want to use and the specific cars. And I'll show you why that matters as far as the cars go. This customer is picking out a 2015 Toyota Corolla with low miles. One thing you need to realize, a lot of the banks are going to ask and request a auto check. The reason is a lot of the prime banks will not do frame damage, airbags deployed, or any type of lemon defaults, rebuilt titles, salvage titles. Now, there are a lot of banks that do frame damage and other things, but those are usually the subprime and the deep subprime banks. And there's actually a few banks that do salvaged and rebuilt titles as well, which I'll go into in another video. But for now, we just want to structure on those 3 particular deals because these are the ones you're going to use the most at your dealership. So make sure that when you're lining up the customer for their car, you should know which one of your cars passed the auto check mark. If they don't, put a little A in the window or a little star or something so your guys know that if a customer starts talking about how great credit they are and they have a credit union financing, stuff like that, some of this won't matter, but sometimes it does come into play. So make sure you check with your banks as far as that goes. Okay, Kelley Blue Book, one of the things you're going to need to structure your deal is this right here. This is the Kelley Wholesale Blue Book on this vehicle. And the way you're going to structure it out is it's all going to depending on your LTV. Now, if somebody has good credit, you can go between 130% LTV to, I have some banks that let me do 165% LTV, which is loan to value. So let's grab our calculator real quick. We're going to type in the 8980, and then we're going to times that by, let's say if this customer, we want to see what we can start them off at. So we times that by 130, hit the percent, equal. Okay, $11,664. So I'm just going to put this right here in the top in the corner just to show you guys real quick what I'm doing. And once again, I apologize for my horrible handwriting. So this dollar amount right here is the max amount we could finance at 130%. Now let's do this exact same thing with the 165%, and we're going to write this number right below that. Now these are some of the things that is always going to be the same with deep subprime, prime, and regular banks, because the worse the credit is, the lower the LTV is going to be. So keep that in mind, and we're going to go over those deals too. So we're going to do the 8980 times 165% equals 14,817. So let's go ahead and put that up there. 14,817. All right. Next thing we need to worry about, which I'll go over in these numbers here in a minute. Next thing we need to worry about is payment to income, or your PTI, or your DTI, debt to income. So when the customer usually has really good credit, the banks won't really beat you up as much as this. They don't set you on that, so it's okay. But it's always good to know for your brain. Find out what your bank's requirements. They want a certain DTI and a PTI, PTI. So some of the banks will only say, hey, we can only go 20% of his payment to income. So whatever his income is, do that by 20% or 30%, and that's the most you could possibly do for a payment. So learn those bank programs like we talked about earlier. Okay, so let's go to the next step, which is the deal. We're selling the car for $10,000. Taxes are $865. Doc fees, always add your doc fees. The banks do not include them in your regular numbers, so that's free money. Don't leave that on the table. $500 doc fee. I do $495. The customer's down payment is $1,500. His amount financed is $98. Let me put my phone down. Sorry about that. His amount financed is $98.65. 65 payments at 5% is going to make his payment a whopping $173. Now, the reason I check mark this right here, the amount financed, is with this customer's credit and with the LTV that we have on the vehicle, at 130%, he qualifies to finance up to minimum $11,674. But if you look to our amount to finance, it's only $98.65. So this is your opportunity to upsell. When you get these good credit customers, you should have, once you know that they have good credit and they have a little bit of money, this is your time to sell them Gap. Make sure they cover their warranties. Make sure they cover the loan. Upsell the service contracts or warranty companies. Make sure you have 3 to 5 of those at least. So you can tell, hey, Mr. Customer, we can do this really great deal. We can add a service warranty onto your car. Plant the seed. Now, don't tell them what the prices are, so you have to find that out when you go in the finance, because I'm going to show you why. So we've sent them out for 65 months at 5% at $173. Now, this is the way you submit the deal. When you submit the deal, the bank's always going to come back with something different. But you want to try to ask for the very most you possibly can, and the bank will try to work your way back, and you meet somewhere in the middle. So let's say the customer or the bank calls you up and says, okay, everything looks good. Customer's got a great credit score. He's got paid auto loans. He's a stud. So guess what? Good news. Your fee, your buy fee, $0. They're not going to charge you a single fee because the customer's got good credit. So now we're already in the green because we know we're going to make some money. The amount financed, they tell them, you know what, Mr. Customer, they're so low on the LTV marker, we're going to approve you for the $9,800. So now your amount financed is approved at the $98.65. Okay, so now we're like, oh, everything's looking good. Bank's going to say, you know what? This is a nice car, but it's not that nice. It's not that new. So we're not going to hit you at 60 months or give you 65, we're only going to give you 60 months. Okay? And then they say, okay, 5%, that's fine. But they're going to okay you for the 5%. But they're willing to give you an extra $350 to $450 if you could bump the customer to 6 to 7%. This is where you get your back-end money. So the warranties and the gap, that is also back-end money. But the other way to do it is to hold back percentages. Now they do this a lot in franchise stores. Independents, not so much, because you know, where I'm at, we don't get a lot of people with a 700 credit score. So, you know, when we get those people, we try to know these programs. So this way you can maximize your dollar amount. So this helps you sell, you know, the plans that you're going to. So like if I was working this deal, I would tell the customer, hey, you have great credit, but the car's older. Your payments might be $275 a month. Plant that seed there. They're thinking, okay, my payments are going to be $270, but that's still cheap. You know, I'm only going to have to put $1,500 down. And now we already got in their head that, okay, $275, this amount of money down, I can afford this car. So this is your job next, where we know our points to make an extra, $350 to $450. Now we can add on the warranties and the gap. So we can say, hey, Mr. Customer, if you add gap for $595, your profit out of that gap is probably going to be $200. So we're adding that $200 onto our check. So when you add gap, a lot of times the banks will increase the amount finance. The monthly finance. So instead of 60 months, let's say now that you added gap, they bump it out to 63 months. So now your payment drops down a little bit lower, close to where you're at before. So now you're excited. You're like, okay, great. We're getting closer and we're making even more money. So let's bump up the interest rate. Let's get another $450 out of this deal. So let's go ahead and we'll bump the interest rate up to, let's say, 6%. All right. And then now we got all these numbers and we're like, okay, we're going to put on a 2-year warranty. 2-year warranty is about $1,000 on this car. $1,000 is the price you're charging the customer. Your cost is close to about $700 on your average warranty company. So the rest of the money, the $300 other dollars, is profit. So now with this warranty, you can talk the bank into, hey, we're adding the gap, we're adding the warranty, the customer is covered. Can we go back out to that original 260, or excuse me, can we go out to that original 65 months? Sometimes they'll say yes, sometimes they'll give you even more since you added the warranty. So now the bank's like, okay, we'll go out to 66 months, keep your payments around, let's say, 235-ish. So now the customer is going to be ecstatic. Let me delete this one. 235. So now you show the customer, hey, look, I got you this great deal with this car for only $235 a month. And I got you the warranties, the gaps, you're protected completely from head to toe. Most of the people will be excited. You kept them under that $275 mark, which you planted the seed for when you were talking to him. And this kind of gives you the options. And the great thing is this is just, let's say, one of the approvals. Remember, you need to have 3 to 5 of each of these banks. So each of these banks now are going to compete. Some might give you more upfront money. Some might give you what's called participation money for holding back points and interest. So there's a lot of great things you can do with this particular deal and all the options you have. But unfortunately, it only comes when a customer has a good credit score. When they have a 700 plus score, you can make all the money, and it's just a great thing. Now, the next one we're going to show you is the subprime deal. A little bit of difference, but there's a lot of major changes in the stuff you have to watch out for. Because the good thing about all this that I showed you right here is there's no fees and there's no recourse on this deal. So this is going to be a subprime deal. We already went over most of the basics in the very first one, so this one should go along a little bit quicker. Most of the things are the same, but these are some of the issues you're going to have with subprime deals. So see if you spot the differences and then go over the video once or twice just so you understand them. So everything's almost going to be the same. Mr. John Smith, 1 year on the job, $3,000 a month, $500 his rent. Now his credit is changed. He's got one auto loan. He's been late on it a few times. His credit cards are 50%. He's been late a few times on his credit cards, and he has one or two things in collection. So this customer right now is a 610 credit score. Okay, a lot different than the other John Smith that was at 720. So we go back, exact same car as the other customer before. So 2015 Toyota Corolla. Once again, double check the auto check, because even some of the subprime banks will ask, but these banks ask a lot less. They're more worried about the customer than the actual car when it comes to lending on the 600 credit score. So Kelley Blue Book's the same. Now here's the difference. One of the first differences, LTV. So when they have a 610 credit score, they can give us, instead of like 130 to 160, it's going to be 100 to maybe 115 LTV. So let's go ahead and add that up real quick. I'll break out the calculator. Equals 10,327. Let's go ahead and put that number right there. 10,327. Okay. Now that is the high end. Let's go ahead and let's do it by the 110. So we're going to take 8980. We're going to times that by 100%. And if you look at the number, it's 8980. It's the exact same amount of what the actual Kelley Blue Book is. So let's go ahead and put that down there. 8980. Okay. Deal's exactly the same structure. We're going to sell the car for $10,000. His amount financed is going to be the exact same, $98.65. 60 months, because he doesn't qualify for 65, so automatically his payment's going to go up from the other John Smith. We can't get him nowhere near to 5%, but we're going to try to get him at 10%. Always start lower. Once you get more familiar with your banks, you'll know what customers you can send in at what interest rate. So let's send him in with 10, and let's just say for fun, his payment's going to be 250-ish, okay? Shoot him out there. More than likely, the bank's going to say no. They're going to look at the credit. They're going to look at the DTI. They're going to say, you know what? This doesn't make any sense. So let's go to the approval and the fees. So with a lot of these customers that have this type of credit, some will cap you on your PTI, payments income, and your DTI. So what you need to do is you need to subtract a lot of this. So let's say they hit you at, okay, customer's payment cannot exceed 15% PTI. Okay, what that means is you need to take their total income, which is $3,000. You need to minus the $500 he pays for rent. And let's say all of his credit cards and everything else is an additional $500. So his PTI, if you want to figure it out real quick, it's going to be $2,000 for his income after the minus of the expenses. Times that by 15% is probably going to give you somewhere around $300. Now, his max payment can be no more than $300. So keep that in mind. If they cap you off at a PTI, this is all you can do. So if they decide that they want to cut your rate and say, or cut your term and say, we'll only qualify for 38 months and your payment's $500, the only way you're going to get this deal to happen is if he puts more money down. So let's just work it off of this, where they're saying that his payment to income is 15%. But they just whacked this at, okay, so let's say the bank comes back with its approval. And they tell you, all right, your PTI can be no more than $300. So you need to make sure your payment's under $300. Your can only finance max up to 42 months. And your interest rate goes from 10% all the way up to 15.95. So as we add up all the numbers, we realize that now that payment of $250 is gone. The customer's payment just jumped to $308. But now that we know that it jumped to $308, we remembered, hey, the bank put the stipulation in the customer's payment can be no more than $300. So we need to make sure that we abide by that and figure out how to change that. Now there's one of two ways. Either you give up some money or the customer gives up some money. So usually what I like to do is I try to give them a strategy. I'll say, hey, Mr. Customer, the bank came back, your credit was good, but it wasn't as good as what we thought it was. So they want to charge you 19.99% interest. We thought that we get a better rate, but with your credit, not so much. But if you put $500 down extra, I can buy your score down or your credit, or excuse me, your interest rate down to 15.95. Isn't that great? You'll save hundreds of dollars on your loan. Oh, that's great. No problem. So now you bump the customer up. Your $1,500 is gone. Now you got $2,000. Oop, that's $200. So now you got $2,000 down. That drops the payment to $292. Now you're under the bank's requirements for this. The customer's already happy that you're getting them at the 15% interest rate, and the term has been cut back to 42 months. Now, with some of these subprime banks, they're going to try to basically trick you one way or the other out of money. So they're either going to set you at a really low payment to make you drop your money, or make you raise the customer's down payment. Some will even ask you for that. They'll say, hey, look, we'll take the customer only with a larger down payment, or they say, hey, your amount financed is too high. They may just come back and say, this customer is approved for $9,000 flat. So now you have to work backwards from that $9,000 number to get exactly where you're at. It's pretty easy in the software. If you use Dealer Center, that's what I use. Make sure you use that software. Put that in there, your approvals automatically formulate every time you submit a deal, and this automatically auto structures so you can see where you're losing money, where you need to make it up at. So remember, subprime deals, it's almost the same as the prime, but, oh, and I didn't even get to the best part, the fee. So this customer's good credit, everything is great, but they're going to charge you a $595 fee, which is pretty normal for the subprime deals. Now, some charge you just a flat fee. Some charge you what's called a discount fee, or a fee, either way, they're taking money out of your pocket, and they charge you an acquisition fee. I have a bank, they do the same thing all the time. Oh, your fee's only $559, but your acquisition fee is $150. So technically your fee's a lot more than that, but they want to charge you separately to make it sound like it's not that much. And read the approvals. They will try to hide stuff. Now, with this particular job, remember how we talked about Recourse? Well, this one, the customer's a little bit better credit, less risk. They're going to charge you that fee, but now you're on the hook for a one-payment Recourse. I'm going to circle that. I'm always going to circle the Recourse just to let you know that that is scary. So now you know that Mr. John Smith is married to you for 1 month. So when your day 30 comes and you're handing him his DRS and his placard's expired, Mr. John Smith, have you made your payment on time? Make sure you make your first 90 payments on time, because it's very important. Once you plant that seed, check on them, make sure they made their payment. You're out of Recourse, and you'll save that. Okay, and we're going to get into the next one, which is the bad credit. Okay, this one is going to be on people with bad credit. So we're going to go over this one pretty quickly. I'm trying not to make the video 30 minutes long, but let me know if you have any questions in the comments below. I'll try to answer everything as much as I can. So everything's the same, John Smith, but this time instead of 1 year on his job, he's only got 6 months. His income's down to $2,000, rent's $500. He's got one repo and one collection. Same car, Kelly Blue Book's $89.95. Now, with people with bad credit, the LTV is going to be cut short. So like primes, you saw it be like 100 to 115. This is very similar, but they'll go all the way down to 80% of LTV to maybe max 110% LTV. Now, some of this LTV depends on the bank. So some banks, if you buy a car under $5,000, they'll go to 125,000 or 125% LTV. Some banks, once you get over $10,000, they drop it back down to like 110. So like I said, go over your bank programs, find out which bank does what. So this way, as you're structuring this deal, you'll know exactly how to set it up. So we'll kind of quickly go over this one. Everything comes out the same. Okay, you take the, once again, 89.80. 89.80. Times that by, let's just go in the middle of both of these. Let's say, let's go 95%. Times 95% equals 85, 30, or 8, yeah, $8,531. Sorry, my horrible handwriting. All right. So this is at their 95% LTV range. Our financed amount is $98.65. So we automatically already know that the customer does not qualify. So we're going to go over here to the approvals and fees. So we just did the LTV and it came out to $8,531 at 95% LTV. So the bank is going to cap us at this particular dollar amount. So if you look right here, the amount financed is $9,800. We're basically off about $1,300. So we have one of two options. The bank is either telling us to switch the customer to a lower, cheaper car, which sometimes that happens. They'll actually sometimes give you what's called a counter. Hey, you know what? We like this customer, but we're only going to do a max financing of $8,500. So they give you a way to go. Sometimes they'll just flat out say no. Other times they'll be tricky. They'll say, okay, we want the customer to put minimum $2,000 down. Maybe the sales amount, oh, we'll take that away, but we'll give you a lower fee. Let's say the fee on this deal, since the customer has bad credit, the buy fee, sorry, my handwriting's so bad. The buy fee is, let's say $1,500. So this is a little glimpse into the world of Las Vegas lending. 90% of our customers, we're getting $1,500 fees all day long, every day. So we have a $1,500 fee. So you call the bank, hey, you know what? I can't get the customer a bigger down payment. If I get maybe $2,000, can you lower your fee? So sometimes they'll say yes, but you got to make sure you keep an eye on all of your numbers because, like I said, they're going to steal money out of one pocket and try to put it in another. So they'll say, okay, you know what? We'll lower our fee to $1,200. They'll resend you another approval. But your amount financed went from, let's say it was 85. So let's X this out. We'll go $8,500. Flat. And then on top of that, they said, you know what? We don't like this interest. Let's give this customer 29.99. So now we're like, crap, the customer's payment just pretty much doubled to $350 a month, 29%. They said, okay, on the 48 months. But then all they're going to do is keep playing with this. So every time you ask for $1 more, well, look, I need at least $9,000 to make some money on this deal. And most banks know how much money you're making on the car. They know what they go for the auction. So if they know you're making $1,000 at $9,000, they want to hold on every penny to try to make you scream. So what they're going to do is, okay, I'll tell you what, we'll give you the $9,000 check, but we want 42 months instead of 48. So now you have to start talking to the customer. Hey man, your payment just went up to, let's say, $375. So now the customer's upset, his payment's going up, and the $1,500 doesn't work anymore. Now we got to get $2,000. So this is what you can do on your end. This is what the bank is doing on their end. Now that they know they got you pinned, they're gonna talk you out $800, but they're gonna try to make you stick to the deal. So now that you're getting $2,000 down and you're getting your term down to 42 months, they're gonna say, okay, well, you know what? Our buy fee still stays at $1,200, but we really don't like this customer. So for us to keep our buy fee here and to give you this amount financed, we're gonna add 2 to 3 payments, recourse, the dreaded R. So 99% of your freaking deep subprime deals are going to end like this. All they're going to do is make you lower the sales price, or they're going to make you lower your finance amount. They're going to raise your fee, and they're going to always cut term. Basically, whatever they can do to give them as least risk as possible. And the downfall is no matter which one you pull, it's like pulling a string on a sweater. It just, either way you go, the deal's gonna unravel. So if you try to ask for more term, they're gonna hit you with more down payment. If you say, well, I need the term, but I can't get the down payment, then your fee goes up. Well, I can't get more down payment, I can't get more term, but I'll tell you what, if you get 2 more 3-payment recourse, we'll add maybe $200 off that and an extra month on your payment. And that's how they get you. Sometimes it's easier just to walk away from the deal, or it's your job as a dealer to sell this customer. Say, hey, Mr. Customer, you know what? I know you really want this 2015 Corolla. I can't get it for you. The numbers are just too far off. But I tell you what, I have a beautiful 2010 Corolla that I can get you into. It's 5 years older. It has 20,000 miles. But instead of it selling for $10,000, this car right here is only $79.95. Mr. Customer, with your $1,500 down, you'll have a $294 payment. Your interest will be 24.95, and you'll be a happy customer. So sometimes the banks won't flat out tell you no. They'll just keep digging in your pocket to see how low you'll go and how desperate you'll get and how much recourse you'll get. So when you start working these deals, don't be afraid to walk away from a deal. Sometimes it hurts. You see the money walk out the door, but it's not worth this. I'm telling you, do not sign up too many recourse payments, because if this customer defaults, next thing you know, the bank's gonna knock on your door like, hey, remember how we advanced you that $8,500? I need that check back. And I don't care if you find the car or if the car's crashed or in the ocean. You still have to pay that $8,500 back. So like I said, walk the customer down, give them options. Usually what I like to do when we start doing the financing, I make them look for a car, but I do the customer evaluation before. So as you're walking with the customer, you're asking them, hey, what do you do for a living? How much money do you make? How long you been in the area? If you had any repos in the last year. As you're starting to collect all this data, you need to be pointing them to specific cars. Our cars, my car lot is sectioned off in rows. Rip this one off. So the outside is all my expensive cars. And then as we go inside, each row gets cheaper. So when you walk in from the office, which is right here, if I know they have bad credit, we stop right here. We never let them walk out to the front where all the nice cars are at. We keep them down here. So you need to make sure that you're starting to let your customer know that, hey, you know what? After what your folks are telling me, I don't think these cars are up here for you. We need to stay away from the $15,000 cars. Let's walk you down to something between $5,000 and $8,000 to build your credit. How's that sound to you folks? Fantastic. Go out here. I usually try to pick 2 to 3 cars. I make them do this on purpose. I'm like, hey, pick the car that you guys like the most. Then let's say it's maybe this row. Okay, great. So you got this car. I need you to pick 2 more that's from over here. Make them pick 2 more cars. Once they pick the cars, they took that kind of not really true mental ownership, but you can at least say, hey, you know what? I couldn't get you approved on this car, but I can get you approved on these 2 cars. Which option would you like to go with, folks? And you can give them the numbers. If this number is really high, then you could say, hey, you really want this one, but you have to pay more to get the car you want. So there's a few different ways you can leverage it, but the banks are very important, like I said, to your success. Take the time, get as many as you can. Make sure you sign up the right banks, build the rapport, and make sure from day one, do not sign recourse. It is a death. It literally will kill your dealership faster than you know it. Because all it takes is 1 month and 4 or 5, sometimes 6, 7 deals, and you're gone. If you have any other questions, go ahead and hit me up in the comment box. My email's on there too. I'm going to try to do a better job of posting videos. I'm sorry, it's been about a month and a half since I did the last one. We just got busy with tax season at my dealership, but now that it's kind of trickled down, I'm going to try to do at least not every week videos, but every 2 weeks. So the next one we're going to be doing is about the flooring lines, floor plans, next gear versus AFC. Go ahead and stay tuned for that. Hit us up on Instagram. If you haven't already, subscribe, and we'll see you guys next time.